So I will start with today. Problem number 13, question booklet, page number 42. Vani and Sandhya are partners sharing profits and losses in the proportion of 3/5 and 2/5. So proportion is given. When it is converted into ratio, it will be 3:2. Their balance sheet as on 31/3/2018 was as follows. Look at the asset side, cash at bank, stock, debtors, less PDD. So already there is a provision for doubtful debts, furniture, buildings, and machinery. Then coming to the liability side, you have creditors, reserve, and P&L account. So instead of calling it as reserve fund, instead of calling it as general reserve, they called it as just reserve. It is same as reserve fund or general reserve. Then capitals of Vani and Sandhya are being given. On 1/4/2018, Chaya is admitted into partnership on the following terms. A. She should bring 40,000 rupees as capital for 1/4 share, and goodwill of the firm is valued at rupees 25,000. So you have to watch out for the words, very important. Valued. Goodwill of the firm is valued. Underline the word is valued or just valued. And you also have to underline goodwill of the firm. It is not for one partner, it is for all the three partners together, 25,000. Next, depreciate furniture by 10%, appreciate buildings by 20%. Next one, PDD is increased by, underline the word by, 3,000. Last one, an amount of rupees 2,000 due to a creditor is not likely to be claimed and hence to be written off. Prepare revaluation account, partners capital accounts, and new balance sheet of the firm. This is a problem given. First, we have to prepare, as usual, revaluation account. So page number 42. Problem number 13. I have the pro forma ready for revaluation account. So let me get into the adjustment B. Depreciate furniture by 10%. Furniture value here in the balance sheet 10,000. So decrease in the value of asset to be debited to revaluation account. Furniture account. ₹1,000 is the depreciation value. Next, appreciate buildings by 20%. Buildings value is 40,000 in the balance sheet. So appreciate is increase in the value of asset. It is a gain for the business. It will come onto the credit side. By buildings account, 40,000 into 20/100. 20% of 40,000 is rupees 8,000. Next, PDD is increased by 3,000. Already there is a PDD of 3,000. They want addition to that 3,000, another 3,000 to be added. So they're expecting further loss of 3,000. So it will be again decrease in the value of an asset, or we can say increase in the value of an liability, however we can say. So 3,000 rupees as it is, debit side. Next, an amount of rupees 2,000 due to a creditor. That means 2,000 to be paid by the business to one of the suppliers or one of the creditors is not likely to be claimed. So that person will not ask the money of rupees 2,000. So because he is not going to ask, they said, and the hence to be written off. See the creditors in the balance sheet, 77,500 is there. Out of 77,500, 2,000 rupees need not to be paid by the business. So business need not pay 2,000 means the liability will reduce by 2,000. So decrease in liability is also equal to gain. So by creditors account 2,000. So the writing account is important. That only is a journal entry. Otherwise, it is the information. So you have to remember whether you are making an entry or not. So if you want full marks in the exam, you have to write the names very clearly. Then 10,000, credit side is more, debit is only 4,000. So we have to balance. Balance will be 6,000. It is nothing but revaluation profit because credit is more. So this amount to be transferred to old partners capital accounts. Old partners are Vani, 6,000 rupees into 3 by 5. That will be equal to 3,600. Sandhya has a share in the profit 2 by 5. So 2,400. So you have to check before you proceed further all the time whether your answers are right or wrong. So revaluation profit is done and the profit has been shared among the partners also. Next we move on to the next adjustment, that is Chaya is admitted into partnership on the following terms. She should bring rupees 40,000 as capital. So we have here cash at bank in the balance sheet. So when we are making an entry for that, journal entry for capital brought in by the new partner. So here, instead of cash account debit, we take it as bank account debit because it is cash at bank. If it is cash in hand, we take as cash account only. If it is through bank, we make it through bank. So new partner's name is Chaya. So bank account debtor to Chaya's capital account, 40,000 rupees. Bank is the receiver, Chaya is the giver. Both are personal accounts. Next part of it, capital for 1/4 share. That will be helpful for calculation of goodwill. And goodwill of the firm is valued at 25,000. Goodwill of the firm is valued at 25,000. So underline the word of the firm and valued. So here you can see the heading. When a goodwill amount is valued in the books of the firm, so what will be the entry given therein? So new partner gives to old partner. So we have to write Chaya's capital account debtor to Vani's capital account and Sandhya's capital account. But what is the goodwill? We should not take 25,000. We have to find out how much is the one. So I'll go for the note first. Goodwill of the firm is valued at 25,000. So where it is given? It is given in the problem. This is most important first one. Then out of 25,000, the new partner's goodwill is how much? So 25,000 into 1/4. So if you calculate 25,000 into 1/4, you find 6250 is Chaya's share. So this Chaya's share of goodwill to be divided among old partners in their old ratio. Old ratio is 3:2, that is equal to 5. So that to be divided among old partners. So Vani's account 6250 into 3/5. We have to check how much Vani will get out of that amount.
So 3750.
Yeah, 3750. Then the next person, Sandhya, 6250 into
2500, sir.
good 2550
Zero
05
zero, sir.
00. Okay, 2,500. So the new partner share of goodwill is only 6250. That has to be shared among the old partners. So when we are entering here, Chaya's capital account is only 6250. Chaya's account debtor to Vani's account 3750, and for the partner 2,500. So please remember this, very important. So this is the one to be understood by you. In the problem, it is given very clearly goodwill of the firm. So goodwill of the firm. Sometimes they may give new partner share. So if they give new partner share, from here we'll be starting. What is the share of that person? Divide among the old partners. That's all. So the words we have to be very careful. Goodwill of the firm is the one you have to observe. So in the entry, being new partner share of goodwill of rupees 6250 divided among old partners in 3:2, that is equal to 5. So you can see the entry carefully. So when the goodwill of the firm is valued at, what to be the entry and how to go about is the one you have to remember well. So this entry will post it to the capital accounts further. So we come to the next account, combined partners capital account. So usually we start this with the opening balance brought down, that is the capital value from the balance sheet. If you look at the balance sheet, capitals are 60,000 and 30,000 for Vani and Sandhya, both on liabilities side. So liability shows credit balance. So 60,000 and 30,000, first step. The second step is looking for reserves. So we have a reserve here, 20,000 on the liabilities side. So it has to come as by reserve account. So what is the amount?
12,000,
We
sir.
have got 20,000 here, 20,000 in ratio 3:2. So that 20,000 reserve has to be divided among partners.
Sir, 12,000 and 8,000.
Good. After reserves, the third step is looking for P&L account. See, when you divide reserves and P&L account among the partners, old partners only, it should not come to the new balance sheet. So P&L account is given on the liabilities side. So I'm writing on the credit side. It is, we call it as credit balance, or we call it as profit. So how much is the P&L account? 5,000 rupees in 3:2 ratio. It comes to 3,000 and 2,000. Remember, P&L account may appear on asset side also. If asset side comes, you have to debit to the partners to P&L account. So third step is done. The fourth step is revaluation account, balance. So balance amount was divided among the partners, 3,600 and 2,400. So opposite side it comes from two side, that is a debit side, it comes to credit side, 3,600 and 2,400. This is what very important for you to remember step by step, so it will not miss anything. The fifth step is capital brought in. So capital brought in by new partner is 40,000 through bank. Because it is cash at bank, we also made an entry also earlier, that is bank account debtor to new partners capital account. New partner is Chaya. She is getting 40,000 rupees. So this 40,000 will be added to the value of bank balance. Next is the goodwill that we have done here. Chaya's account tethered to Vani's capital account to Sandhya's capital account. So first we will credit it 3,750 and 2,500. So by Chaya's capital account, goodwill of rupees 6,250 in 3:2 ratio. So with this also you can remember, no need of journal entry. With this also you can remember about goodwill, how to be done. So this 3,500 to be debited, sorry, 3,750 to be debited to Chaya, the new partner, and also 2,500 to be debited to Chaya, because Chaya is giving to Vani 3,750, she is giving to Sandhya 2,500. So you can see here Chaya's account data to Vani's account. So Chaya is giving to Vani. Again, Chaya is giving to Sandhya. So from capital account itself, capital amount itself, the goodwill value will be deducted. So we have to go for balancing the accounts now. So credit is more. So that is why I am totaling on the credit side. You can also check once. For Vani, no debit side entry is there. So the closing balance itself will be the balance value also. But for the new partner, the capital will reduce because out of the capital only the goodwill amount is deducted. So that is closing balance carried down is a balance amount of the each partner's capital account. The same will become opening balance brought down. Opening balance brought down. So this is important for you to remember. If this comes out right, your other things will be right. So here instead of cash account, we are going to prepare a bank account. So no need of that I told, but still if you want, you can work. 21,500 is the opening balance. To opening balance 21,500 to Chaya's capital account. So Chaya has got 40,000 towards the capital. So balance to be done, that amount will come to the balance sheet, that is 61,500. So 61,500 will come to the balance sheet, cash at bank. So 61,500, yeah, correct. Next, I can go for new balance sheet, revising the values of assets as well as the liabilities. So cash at bank I have written instead of 21,500, new value I have written. We'll go to the stock, next one. Check, there is no adjustment for stock. So outer column, 39,000. Next, debtors, 60,000. Inner column, less PDD. Old one, 3,000. New one is also 3,000. So total PDD is 6,000. So adjusted debtors 54,000. So you have to remember this, very, very important, how to calculate the PDD. Old 3,000 plus 3,000, that is what they are told, increase it by 3,000. So if you add 3,000 to that, it becomes 6,000 PDD. So next one after debtors is furniture. For furniture, we have an adjustment. Remember, depreciate. So let's see the way I am writing. This is the way you have to write. Not to use plus and minus. You may go wrong there. Next, buildings 40,000. Inner column, because we have an adjustment, add appreciation. Appreciation is increase 8,000 rupees. That becomes 48,000 new value for building. Next, machinery 25,000. We don't have entry for machinery. No, so no adjustment for machinery. So machinery value 25,000 as it is. Next, coming to the liabilities side, only creditors. Creditors, we have an adjustment for a new way or first time. Rare occurrence, very rare. We call it as written off. Written off means reduce. So liability reduced. So I told about this liability reduction happening in the balance sheet. That is what they had told in the adjustment also. An amount of 2,000 due to creditors is not likely to be claimed and hence to be written off. Written off means reduce. So in the balance sheet, they are told to be reduced. So we have done now that 2,000 already we are taken in the revaluation account. Next, reserves will not come. We have divided among partners. P&L account, we have divided among the partners. Next is capital accounts. For that, we have to take the new values for all the three partners. Vani, Sandhya, and Chaya. So for them, which value we have to take? The question comes, that is the new values. Is the opening value or closing value, both are same. So those values to be taken here, copied carefully to the balance sheet. So 33,750 is the new partner's capital account value. Very careful. Then before closing the balance sheet, always have a practice of checking whether all the items of revaluation have appeared in the balance sheet or not. So for example, building 8,000 we have taken, creditors we have taken, furniture is taken, PDD is taken. So if you ensure that, the balance sheet may tally in the beginning only. So nothing is left. We can go for totaling.
Sir, it's 236500.
2, 3.
6500.
0, 0. Oh, okay. 2,36,500. So you can check on both the sides. And ensure you have done right the working, the calculations, the deductions, additions,